Hello, everyone. Welcome to video 3 for CCA. We've been talking about capital cost allowance. We've gone through some of the preliminary rules, and now I want to talk about the actual classes involved in depreciable property. So when you have accounting, we look at each asset by itself, we figure out the amortization expense, and then we add all the expense together and deduct it from our financial statements, from our income. From the tax perspective, each property kind of falls into a class. I like to just call them buckets or bins. So this bucket holds all of our automobiles. This bucket holds all of our general equipment. This bucket holds our buildings. So schedules 2 through 6 provide detailed listing of depreciable property classes and rates. If you have the textbook, I think pages 277 to 281 gives a good summary of the most common classes we use. We will go through a handful of them on the slides, but if you want a bit more of an in-depth discussion, you can go to the textbook for that. There are over 66 classes. Some are extremely narrow, where there's only one type of property that fits it. Others are extremely broad. Class 8 is a very broad class. It kind of holds everything that doesn't go into any of the other classes. So there's a wide variety of assets that go into there. Whereas, class 6 only holds taxi cabs. So what falls into one class can be very specific, but they also can be catch-all classes for other things. Incorrect classification can be costly in terms of loss deductions, which impacts taxable income and then taxes payable, right? The bigger a CCA claim we can make, the more it will subtract from income. The lower we get our taxable income, the smaller our tax obligation is. So knowing date of property purchase is important to determine correct classes. There's a few classes that have sort of cutoff dates. So you need to know specifically when an asset was purchased because it might fall into this class and then past the cutoff date a week later, it goes into a different class. So you usually need to be aware when rule changes occur. We'll highlight some dates of when these rules change, but I would say they're moderately rare. It's not like we change these rules multiple times in a year. We just usually need to know when a change happens. For example, when the accelerated investment incentive came into place in November of 2018, new assets could accelerate or have a higher CCA calculation in their first year. But anything purchased October of 2018 had to hold the usual half-year rules. So we need to know the explicit date that something was purchased in order to see where it falls between two sides of a rule change. If you could have separate classes occur on separate businesses. So this is based on the source concept. So I have a business that prints t-shirts. Every asset I have associated with that business of printing shirts will go into the respective class buckets. If I have another business that makes jeans, so I have a machine for, so I have sewing machines in order to make the jeans, they're not associated with the making of the t-shirts. So even though these two machines might fall into the same class normally, because they're separate businesses, they will go into two different buckets. So which classes you have are specific to the business, and you'll have separate classes for every business you're running. For rental properties, buildings acquired after 1971 and cost $50,000 or more are commonly put into their own classes. Buildings are very large, they're very expensive, and so when you sell a building, it's easily identifiable as separate from the other buildings. So after 1971, there's a big change that allowed us to separate buildings to their own classes, and that helps with disposition rules, which I will get into when we talk about dispositions. Purpose-built residential complex rental housing. This rule came in place in 2024. With the increased cost of housing, they want to incentivize individuals to produce sort of high density rental complexes, basically apartment buildings. So the usual rate for class one for buildings is 4%, but they can get up to 10% if they apply rental projects that began construction after April of 2024. So if I have an apartment building under the old rules, that would probably amortize at 4%. But with these new rules, I can amortize it at 10%, get a bigger expense, save myself some taxes. Class 10.1 is a passenger vehicle. So we will talk about class 10 is most automotive assets. Class 10.1 is for passenger vehicles. It's recognized that assets, what was I saying? It's recognized that vehicles are necessary to for business. We need to meet with clients, we need to transport goods, we need to move staff from one space to another. So yes, we need to be able to travel from point A to point B. But the CRA says there's a certain level of expense where that's reasonable. Once you get up a certain amount, you're no longer paying for the transportation from point A to B. You're paying for luxury. You want to make that trip as nice as possible. But that trip being nice is a benefit to you. It's not a business benefit. Looking good in your car is a benefit to you. So they say passenger vehicles, that's cost is above $38,000 goes into 10.1, it's a limit. So new additions to class 10.1 cannot be more than $38,000. This has increased in recent years. It was 30,000 up to 2022, 34,000, then 36, then 37. So this number increases each year. So right now, it's recognized that if a car costs less than $38,000, that's wholly for business. You're just trying to get from one space to the next. If it's above 38,000, then it's kind of a nicer car and you're probably putting a little bit into your personal benefit for driving it. Elections for separate class treatment, so eligible non-residential buildings, so manufacturing facilities, property subject to high rates of technological obsolescence, photocopiers, and depreciable properties sold as part of business sale. We'll get into these items specifically later, so I'm not going to spend too much on the separate class treatment. Here we are. Now we're into the basic calculation. This is where I want to be. The business owns depreciable property in class 10. Class 10 uses a 30% rate. Excuse me. We'll use a standard calendar year for the period of business. Let's say the UCC starts at $100,000. No dispositions, no acquisitions. If $100,000 is our UCC, we're going to expense 30% through CCA. So 30% of $100,000 is $30,000. So there's the UCC, 100,000. CCA calculation at 30% says we can deduct up to 30,000. And if we do, that leaves only 70,000 behind. So now that 70,000 becomes our new base, our new UCC next year. 30% of 70,000 is only $21,000. So in 2026, the maximum CCA will be 21, not 30. This is called a declining balance. The amount of CCA you can take will reduce each year because the UCC balance will reduce each year. So 70,000 minus 21,000 will be $49,000. So that will become this UCC base in 2027 to take 30% on. If we have the first year half year rule, ignoring accelerated incentive, that $100,000 in our class 10 is now a purchase. So it would have been 30,000 as CCA, but because it's our first year, we only take half. 30% of $50,000 is $15,000. So the standard calculation for CCA halves the incoming addition. So it says, oh, you bought 100,000, we'll take 30% of half of that balance. The same can be done, or you can get the same result, but just saying we're taking half the CCA, 15% on the additions. Wherever you put the half will still come out to the same result, so it doesn't matter. But just be aware of this because I think that's also something that confuses students about, well, which am I halving? The standard CCA calculation because they take half of the UCC, after they do the CCA calculation, they have to put it back in. And I find that that is confusing. So let's stop here momentarily because I have a tab here for the basic CCA. So we're using class 10. In our example, we have $100,000. There we took the 30, moves to 70, we go back up. 70,000 becomes our new UCC. 21,000, 49,000 for the next year comes back up for our beginning. So the next year in 2027, we only take 14,700. This process just continues every year. So each year we move this balance back to the top to do a new calculation. For the half year rule, let's say we have $100,000. Actually, let's keep it zero. Let's say we have no assets, no disposals. We have $100,000 as our acquisitions. So the $100,000 subtracts this 50,000 so that our CCA base is reduced. We'll still take 30% on that CCA, but because we took out $50,000, we only took it out for the calculation. We have to put it back. So they add it back in to get $85,000. This is the exact same thing as just taking 15% on 100,000. The CCA is 15,000, 100,000 minus the CCA taken still gets us to 85,000. The reason it's structured this way is because this is closer to what the tax return actually does. But I feel that this removal of 50% and then adding it back is also a confusing point in this process. So don't worry about it. If you can do it this way, absolutely go for it. But it's the same as just taking our additions and applying half of our CCA rate to it. We'll still be left with the same amount of UCC. So by applying, so this is a first year, half year with the short fiscal period. So we're taking our half year calculation. Our CCA was $15,000, but now we're adjusting it for only 275 days. So we weren't there for a whole year. We were there for 275 days, even though this calculation is showing 265. 265 days. It all works. So the maximum CCA was $15,000. Let's come over here. The maximum CCA was $15,000. We'll times it by 265 days, how long we existed, divided by 365, the number of days in a full year. That comes to 10,890. So they must have used 275 times 275 divided by 365. There's the 11,301. So they did use 275 days, even though the slide says otherwise. So 275 days, that maximum CCA was adjusted from 15,000 to 11,301. So our UCC started at $100,000 and we're left with 88,699. First year ACCU rules. So we have our half year. Our half year says our CCA should be 15,000. We're taking 30% and we're halving our additions. 15,000. The ACCU rules, back to example 4, the ACCU rule says we can double our CCA. Well, 15,000 times 2 is 30,000. 30,000 is also 30% on $100,000. So the CCA is the same as if we didn't have the half year rule. So right now, the accelerated incentive is undoing the half year rule. We had $100,000, 30,000 of CCA leaves us with $70,000. Okay, let's take a moment, talk about some of the most common classes. Most common class 1. This class rate is 4%, 6%, or 10%. It has to do with buildings acquired after 1987. It can also include structures as bridges, canals, and subways. The usual rate is 4%. You can get 10% if it's a new non-residential building used mostly for manufacturing and processing. So manufacturing processing, big buildings, facilities used a lot in the business operation. So they have an increased CCA rate. It's 6% if the new building has manufacturing and processing, um, but it's less than 90%. So this is elective and must use a separate class one. So since we have different class rates, 4%, 10%, 6%, whenever we add something to one of these classes, we have to make sure it's going to the correct percent. Now, there is the rule that pretty much new buildings can just be in their own classes. Um, Also in 10% is now residential complex. So they wanted to encourage apartment buildings to be built. So they're giving apartment buildings the same preferred CCA rate that manufacturers get. And I just mentioned the housing complexes. So these are the 4% buildings acquired after 1987, bridges, canals. The 10% is for manufacturing and processing over 90%. 6% if it's manufacturing processing, but less than 90%. Class 3 is similar to the building classes, but it usually focuses on buildings over water. So breakwaters, docks, trestles can also include windmills, which are and telephone poles, which are kind of tucked in between trestles, wharfs, and jetties. So water-based structures or telephone poles and windmills can have this class 3, 5%. Class 8 is very much a catch-all class. It includes most machinery, most equipment, structures such as kilns, tanks, and vats, and electrical generating, advertising, posters, bulletin boards. It also includes furniture, not specifically included in another class. So any piece of equipment, machinery, or furniture that doesn't find itself in another class will come into Class 8. For that reason, I would say Class 8 is the most common CCA class to be used, and it's usually my go-to when doing example calculations. Class 10 is equipment that are automotive in some way. So it includes most vehicles, but also includes trailers, wagons, movable equipment, TV channel converters, and decoders by a cable system. So you often see forklifts are included in here. We have that says trailers and wagons. Sorry, I was going to try and use an example from farming equipment, but I'm not a farmer and it blanked on it. Excludes passenger vehicles allocated to 10.1. So most vehicles go into 10.1 if you have trucks, vans, but if it's a passenger vehicle for transporting people and it's really nice, it goes to a class 10.1. Taxi cabs are allocated to class 16, and zero emission vehicles are, electric vehicles, EVs, they have their own class, generally because EVs are more expensive than usual vehicles. Class 10.1 is just like class 10, except new vehicles additions are limited to $38,000. So if the cost is more than 38,000, 38,000 is the most you can add to the class. Each passenger vehicle gets a separate 10.1. It has no terminal loss in the year of sale of disposition. 50% of normal CCA is allowed in the year of disposition. Normally, CCA takes place after disposal, so we don't consider them as part of the sales calculation. I'm not sure we're going to throw anything like that at you. The most important thing to know is vehicles over 38,000 to 10.1, and they each get a separate class. There's no recapture and sale of disposition unless the passenger designated a DIEP. So since we're not allowed to recognize all of the cost of the vehicle, it really complicates the disposal calculations. And so for that reason, there's no terminal loss for 10.1, and you get to take just half the normal CCA. And I'm not going to worry too much about DIEP. Class 12 is for small, cheap tools, 100% CCA rate. So it gets fully deducted in the year. Computer software, books in a lending library, dishes, cutlery, jig, dyes, patterns, uniforms, costumes, linen, forks, spoons, if you have a restaurant, motion picture files and videotapes, any tools that cost less than $500. So this class is a catch-all for kind of cheap things that you need to run the business that will be around. So if I have a library, the books are going to be around for a couple of years. So they are capital expenditures. But each individual book is probably quite cheap. So to track it and have depreciation, I guess commonly isn't worth it. So class 12 has 100%. Class 14 is straight line, limited life intangibles. This includes patents, franchises, and concessions. It's straight line over legal life. The one thing about class 14 is we use a reasonable pro rata basis. So normally we only prorate our CCA in the first or last year of a business, but class 14 will have a proration on any additions because they normally apply to franchises, and franchises is almost like the start of a new business. 14.1 is intangibles, includes goodwill, incorporation costs, customer lists. We use a 5% declining balance. And patents, we're going to skip patents. I don't use too much. Class 50 is very popular because it's for your computers. This day and age, almost every business has computers, laptops, smartphones. So the CCA rate for this class is 55%. And class 53 is for declining balances. Is declining balance, it's for manufacturing and processing property. Sorry. Manufacturing equipment goes here. So general equipment goes in class 8, automotive equipment in class 10, manufacturing equipment in class 53. And I'm not going to worry too much about the electric vehicles. Okay. So we're a little over 20 minutes. Let's just do this exercise quickly. For each of the following depreciable properties, indicate the appropriate CCA class. The exercise goes through a handful of assets. To do this task, if you go to Module 5, we have a document here, CCA rates. And it's a document that it's just a list of various assets and the class that they go into and the rate for that particular class. So to do this exercise, you would go through this list, try and find the objects that are here. So the first one is taxi cabs. So if we found, go down to T, taxi cabs right here, not zero emission, class 16. So going through that process would get us this list: taxi cabs in class 16, reference books in class 8. If the periodicals are less than a year, so periodicals are like books, but they get renewed every year. Since they don't have a long lifespan, they are just expense. They don't have a class. Manufacturing equipment to class 53, franchise limited life to 14, passenger vehicles is 10.1. You can go through the rest yourself. I wanted to highlight that class 13, 14, and 29 are straight line instead of declining balance. So we will have exercises specifically dealing with 13 and 14. We will also have an exercise to explicitly discuss class 53. Okay. Let's end that there, since we've discussed the common classes. When we come back, we will do some exercise calculations regarding these classes. Thank you for your time. See you in the next video.